And the same thing, like you were saying with the static payment variable rates, is you end up creating these forever loans.
That's exactly what it is. Like a 35-year amortization at today's interest rate, it's probably somewhere around like if your mortgage payment's $4,000 a month, you're probably paying around like $400 maybe towards principal and $3,600 towards interest in with today's rates and a 35-year amortization. Like that is a forever loan.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. Jeff Mudrick, welcome back again. Thanks so much for joining us. Um, what's going on with rates? It seems like we've been on a roller coaster in terms of what you could actually get from the bank. Obviously, the Bank of Canada has been pretty consistently not moving for the last few months, but I mean, bond yields have been all over the place. Kind of give us a lay of the land. What's going on?
Yeah, so we're talking on Valentine's Day, and Valentine's Day is not really it's not going to favor borrowers too much. Borrowers aren't going to fall in love with what's happening with bond yields today over the past couple days. But I would say like since our last chat, bonds have been kind of plummeting-ish with a few spikes here and there. So we've seen rates drop about a full percent in the past six-ish weeks, which has been great. Lots of opportunities for savings, lots of opportunities for increase in buying power for clients. And from what we're seeing, at least, like the great thing is, I don't think people aren't overpaying on properties yet. There are bidding wars for sure, but it's not that 2020 or 2021 bidding war. We're just like a handful of clients wanting the same property. But over the past kind of 48 hours or so, we're seeing the bond yield spike up high. Lenders have not yet increased their fixed interest rates. Will they? I believe they will probably in the next 48 hours. By Friday, by the end of this week, we'll likely be in flux, getting an influx of emails from lenders saying fixed rates going up.
I got a really interesting email that I wanted to talk to you about, and I wanted to kind of put on our tinfoil hats here for a minute because the last video that I did on YouTube, I outlined that, hey, look, is there reason to be skeptical? Of course there is. We're still, you know, at a broad economic level overspending, right? When it comes to federal deficits, um, money is not tied to anything. And although people think that that's normal, really, that's just the last 50 years or so. I mean, it's for all intents and purposes, it's basically an experiment that we're all kind of stuck in right now. And for most of human history and economic history, that was not the case. So we have these kind of runaway trains happening, and a lot of people in my YouTube comments are skeptical. But I did get one email which I wanted to read to you because I see so much of the skepticism and I see it and I think to myself, it's not completely unfounded. Like there isn't some mass conspiracy that's not true. No, no, no. There are aspects of the financial system that don't make sense. And when it comes to mortgages, same thing. We've talked about this before. We've talked about how appraisals can be bogus, how banks will pay to get the numbers that they need to, how builders will just create performas to highlight certain aspects of what they need it to look like in order to get things going. And at the end of the day, we seem to be kicking the can further and further down the road and somehow have remained free of like any catastrophe. So in this email I got on my last video, she sent it directly to me, uh, basically saying that technically there are a ton of mortgages that are technically in default, but just banks aren't doing anything about it. And they're just kind of waiting for, the market to recover and for the loan to value ratios to restabilize. And if they need to, they'll just kind of rejig, the allowed
Oh,
amortization periods as they normally do and have done for decades. What do you say to that? How do you kind of
Yeah.
come back at that as like saying, "Hey, look, that's true, but here's what you should be doing in order to kind of plan for that."
I would say like any time you have a mortgage where clients are paying essentially interest only or not even paying enough to cover the interest, like that could be considered a mortgage that is in default. So, for example, right now, the maximum amount of time a mortgage can be amortized for through an A lender is 30 years. So we're seeing many A lenders offer these static variable rates or payments where if interest rates go up, your payment stays the same, just more of that payment goes towards interest rather than principal. Right now, because interest rates have gone up so much since 2020 or 2021, um, we're seeing amortizations not at 30 years, not at 40 years, not at 50 years. We've seen like up to like over 100 years. Oh, and the lenders aren't really doing anything about that. So is that mortgage in default? Yeah. Um, so that for sure, it's up to lenders what they actually want to do about that. I agree with the person who emailed you. They're probably waiting. The banks and whatnot are probably waiting for the market to correct itself a little bit, and that will automatically adjust that amortization back, maybe not to schedule, but much further down than 100 years. But the alternative is like many of the clients I'm working with, anytime as a Bank of Canada announcement, we're reaching out and saying, "Hey, what are you thinking? How are you feeling? Here's what I would suggest. If you have extra money in your bank, this is or in your bank account, you got to pay down. You got to increase your monthly payment because paying the bare minimum is not really helping right now." So, everyone's strategy is a little bit different. For people in these variable rates, which have become obviously much less popular over the past 12 months, they always have the opportunity to convert to a fixed rate mortgage. And fixed rate mortgages have dipped down. They're more affordable now. If you were looking as a first time buyer, looking to even just get into the market or to buy a second property, like the spread between a 5-year variable rate mortgage and a 3-year fixed term is like a 1.5% difference right now, which is huge. Um, so, anyways, there are options for these people. Hopefully, that helps to answer the question that she was asking.
Yeah, I would say like when we're looking at the big picture, there's always a question of everything always depends on what the allowable amortization period is. And I guess my question for you is like, who decides that? How does that get decided? It's changed so much over the last, 2 decades. And how does that happen?
I think each lender, the past 2 years is going to have a huge impact in what policies come into place, whether it's the government regulating some banks' policies on amortization schedules or on these allowable mortgage products. Because really, it's only like three lenders out there that have these static variable payments. So it's only those lenders that are going to be in a little bit of trouble with these regulators. So years ago, they had for like every A lender, you can pop up to a 35-year amortization if you want, but it's the federal government, I believe it's federal, rule that hey, we got to crack down. We don't want the more you can extend the amortization, the more buying power people have, the more houses are likely going to go for. That's kind of their rationale for that. So to bring some housing affordability back to everyday Canadians, they dropped that amortization down to 30 years. This was like 7 years ago they did this. Um, and is that going to move again? I don't think so. There's talks about it moving back like to 35. So it's anyone's guess. I would say if you talk to anyone in the federal government in the finance division, they don't know either yet. If you talk to the Bank of Canada about when they're going to cut rates, they don't know yet. Are they going to hold in March? They don't know. It's really dependent on all these reports that come out on a pretty much biweekly basis between what's happening in Canada and the U.S.
And I guess that has a lot to do with things like, our population boom, which is completely out of whack. We have no support systems for housing, medical care, or anything like that that can even support it. Which obviously everyone is kind of looking towards as a huge factor in creating demand for housing, which is going to, push prices up ultimately when people can afford things. And this is kind of what I've been seeing as like the macro solution to all of this, which is, well, if prices have gone crazy and we need to give people more ability to purchase them, we have to extend the amortization periods to allow for, more purchasing power. And what ends up happening is you kind of end up creating, and the same thing, like you were saying with the static payment variable rates, is you end up creating these forever loans.
That's exactly what it is. Like a 35-year amortization at today's interest rate, it's probably somewhere around like if your mortgage payment's $4,000 a month, you're probably paying around like $400 maybe towards principal and $3,600 towards interest in with today's rates and a 35-year amortization. Like that is a forever loan. Um, that's the really scary part. So I agree. Like, what do you do? There's immigration. There's many more immigrants coming to Canada than housing than the number of houses that are being built. So, like you said, all it does is it creates demand. I know they're trying to build more homes, and you see that on the news, but they're not building them fast enough, and it won't be. It really won't be done in time for houses to come back to reality for people trying to get into the market.
So, in a realistic sense, should we be anticipating that, just like over the last 20, 30 years, how amortization rates have, periods have just extended further and further, that as prices continue to climb, that'll just continue? Like, is that a fair assumption to make?
I can maybe like really what I'm seeing right now is a lot of people are concerned about renewals. Like, oh, when my renewal comes up, I'm going to be, going to have to pay so much more. Maybe that will make people sell their homes, and then that's the way there's going to be more inventory. It's not really true. There's so many ways we can play with the renewal on the mortgage front or with lenders. There's um, many creative ways to adapt that mortgage or to reconstruct that mortgage. So payments are essentially the same, maybe an
Give me some
extra like $50
examples.
a month.
Give me
Sure.
some examples. Like, how do you do that?
So I'm working with a couple right now who is tight on funds. Their current mortgage rate is at like 1.74%. They did a 3-year term in 2021. It was incredible. But they're up for renewal, and the current mortgage payment's somewhere around like 2,000 or 2,300 bucks a month. And if they were just going to do a straight renewal, it would increase their mortgage payments to just over $3,000 a month. So like an $800 a month difference, which, can they afford it? Yes. Do they want to afford it? No. So, my job is just to present options. So option one, straight renewal, easy process, sign a piece of paper, you're good to go. Option two, we shop for better interest rates. It might take that $800 increase and bring it to like 720, which is still a lot more money. Or three, and it's obviously a last resort, is just to re-extend that amortization. So if you have 20 years or 15 years left on your mortgage, re-extend it up to 22, 23, 24, 25, maybe 30. And really that $2,200 payment is going to be essentially the same for this couple should they choose to re-extend their amortization.
So, given the fact that there are so many different ways to skin the cat, and that it's not just you who are an independent mortgage broker working towards these types of things, it's also banks wanting to work towards them, because no bank wants to push anything to foreclosure.
No, and
How
no bank wants to discharge a mortgage either. Like they're presenting clients with options to re-extend all the way up as high as you can go. Maybe your mortgage payment comes in under what you're paying now, but you're going from a 15-year amortization. You have 15 years left to pay your mortgage off. You re-extend it up to 30. Now you have 30 years left to pay your mortgage off, but your monthly payments are lower. So that's
right.
that's the scary part.
Right. So nobody on the bank side, on the mortgage side of things, wants anything to ever go to foreclosure, and they have so many different tools in
Yeah.
their toolbox to make sure that that doesn't happen. So when people in the comment section look at things at a very just basic level of, there's no way people can afford this, And obviously, that's going to push a whole bunch of homes to foreclosure like we saw in 2008. How worried are you about that happening?
I would say just seeing what pushing to foreclosure is like, I don't know. I have none of my clients have ever had to go that route. Again, there's re-extending amortization. There's an option to extend it further. Look at alternative lending, which the interest rate's not that much higher, but they provide a lot of like debt relief strategies. Like really, I don't see it as a major issue. The people who I see an issue with is people who bought properties for the sole purpose of flipping. Like if you wanted a quick flip and you bought a property last January and it took you 6 months or 8 months to want to flip it, and now you're flipping it for a couple hundred grand less than what you purchased for, like that's more of an issue. But again, those people aren't going with these A lenders anyways. Those are with private lenders, and it's not it's definitely the exception and not the norm. So like I don't see it being a huge issue over the next year until rates settle down.
So the Bank of Canada has been extremely hawkish, obviously, over the last couple of years, and now they've kind of turned a cheek a bit. They're kind of saying that, hey, look, we're not ready yet, but we're anticipating lowering rates later this year. What is that all dependent on? Because it seems like we're kind of fluttering inflation around the 3% mark. And I know that there has been talk of actually raising the threshold from 2 to 3%. What should we be expecting and what numbers should we be looking at to make sure that we're kind of ahead of the curve and anticipating maybe what might happen?
I know that you and I have been talking about that threshold for years, probably at least 3 years now, or since COVID. Around, I remember one of our first ever podcasts together. You were like, "There's no way. There's no way that inflation is what they're reporting it at. Like it was under 2%. Like there's just no way." Then the report came out. It was at like 6%, something wild. But yeah, so the Bank of Canada is pretty much has said that interest cuts are likely to occur. But again, with every 2 weeks, there's some report that comes out. So like the US CPI came out and it didn't look good for to promote rate cuts recently. Then like the jobs report came out for Canada I believe it was last Friday. Ton of added new jobs. So again, that caused the bond yield market to skyrocket. So when we see stuff like that, it doesn't signal rate cuts anytime soon. Like this is what I mean when I don't think the Bank of Canada really knows what they want or what they're going to do. When they make these announcements that yes, we are planning to raise rates or we're planning to decrease rates, I think that's all based on the information they have at that time. But there's a million and one other factors that will come into play between the time that they say that and the next announcement or next two announcements that you can't take what they say at face value.
For sure. They've been completely wrong on so many fronts so often, and they've had to backpedal so many times and told consumers one thing and then done the complete opposite. The credibility in Tiff McClem and the Bank of Canada has completely degraded, in my opinion. However, they're so their lack of competence is still not something where we can just now write them off, right? They're still controlling what the interest rate is. They're basically holding the economy hostage. So based on unemployment, based on CPI, based on all these other things, should we be more watching what the federal government is doing, how much they're deficit spending? What should we be kind of keeping an eye on in order to try our best to anticipate how things are going to happen?
Like what I always default to, because yeah, you're right. You can't just disregard what the Bank of Canada says, even though they've been wrong before and they've had to backtrack before. Doesn't mean it's going to happen in the future. I like to always, sometimes I'll talk to clients about the game of roulette. It's pretty much a 50-50 shot between you're going to get red or black every spin. But if it spins 10 times, if the first 10 spins are black, it doesn't mean the next one's going to be black. It's still a 50-50 chance. So that's what I like to think with the Bank of Canada is that like you can take what you will. Hey, there's 10 black spins in a row. Hey, they've talked 10 times about decreasing rates. Doesn't mean necessarily it's going to happen. What I always default to is the bond yield market. That gives us a better representation of what's what's actually happening in the markets today. So I know in January when they announced that rates will likely be cut, they didn't really they gave us the impression that rates will likely be cut at some point this year, variable rates. January was the absolute lowest the 5-year bond market was since since May or April of 2023. So we kind of matched that low. Since January, it's up like dramatically with a few dips here and there, but the overall scale is that it's up. So that doesn't really signal to me that rate cuts are happening in the next, March or April or the June announcements. But again, this could all change.
One last thing I want to ask you about. Um, Ultimately, at the end of the day, nobody knows what the hell's going to happen. And it's been a constant discussion within your industry, within my industry, to, we have to guide consumers on a daily basis, basically. And people are always curious because they're nervous, and rightfully so. If they want to buy a house, they want to sell a house, it all has to do with the interest rate and anticipating what that interest rate is going to be, given the fact that we are being told that we should expect rate cuts. Are you seeing people becoming again more confident in variable rates now that that has been signaled?
That's a phenomenal question. And I appreciate you asking it because it's usually me bringing it up to referral partners or to clients just around like, hey, just because variable rates are high, it doesn't mean we should ignore it. Here are the benefits of a variable rate. I am seeing more interest in it right now, but the issue is that it's a full 1.5% higher than what like a short-term fixed rate is. So that is kind of, it's on a monthly basis, it's an astronomical difference. So what I find is most people will defer to that monthly payment and where they're comfortable what they're comfortable spending monthly, as opposed to the actual product. And then it's my job to ensure that the product suits them the best. So here are the benefits of a variable rate in today's market. One, the biggest benefit of, or two benefits, but one is it's lowest penalty in Canada. Should you need to break the mortgage, it's going to cost you it's going to be the cheapest penalty, which is nice. But in today's market, the real benefit of a variable rate is that at any point throughout the term of your mortgage, you can lock in whatever the current fixed rate is with that lender. So the reason why this is so important is that if we project fixed rates to fall into like they've been falling, then why lock in a 5.2% fixed rate today versus doing it in a year, a month from now, a year from now, 2 years from now, when maybe fixed rates are out like 4%. So that is the conversation to be had with clients. I would say to answer your question, there's a little bit more interest now in variable.
So even though it's more expensive because of the anticipated rate cuts, there's still more interest. Canadians are not as risk averse, I guess, as I thought they were at the end of the day. So who are you seeing kind of willing to take a bet on this market? Are you seeing first time buyers coming out to play? Or is this just people kind of investors maybe looking for that possibility of catching a deal before the market rebounds, or trying to anticipate that maybe, hey, maybe we are seeing the bottom of this cycle? What is your take on that?
I am finding that most of the clients who have purchased with me this year are finding properties that like again that we see as deals and lenders see as deals as well. The last time I had to order an appraisal was in 2023, which tells me that lenders are saying this is a steal of a deal. We don't even need an appraisal on this property. I think the industry that's taking the biggest hit right now is the appraisal industry because every lender is just doing their own automated version because they assume that people underpaid for the property or the property value will go up. So that's like the a biggest interest to me right now is that people are kind of finding deals out there.
And frankly, I'm glad to hear that because I've always, I mean, you know my feelings. I've always felt that the appraisal industry is like the most corrupt industry within real estate, right? Like I'm on the transactional side of things. I'm just facilitating transact. I don't make values really go one way or another. It's a negotiation. Appraisers actually do. They really kind of just decide, and you have to kind of watch who are they being paid by, who's ordering the appraisal, what's the track record of that company, who is that particular appraiser, and what's his reputation. They
Like,
do swing markets.
and to be transparent, I know every mortgage broker has their favorite appraiser when they need something to be appraised, like kind of who to call. So yeah, we've talked about this before in another episode, but yeah, full agreement with you there.
How confident are you in these algorithms? I know banks have been using them for a long time. Obviously, they're becoming more sophisticated now with AI, but how confident are you in their ability to actually appraise accurately? Because at the end of the day, real estate is such a nuanced and particular thing. Everything is so anecdotal, right? Properties differ, even if they're very similar. The differences can be substantial between properties, enough that it would swing particular values and pockets one way or another. How confident are you in these algorithms, or is it just that you're so not confident in humans that deferring to an algorithm's better wholesale anyways?
It's a like appraisal. It's a super interesting concept. It's, hey, if you were to, I think you or an appraisal or myself could look at the same property 6 times throughout the year and come up with 6 different values just based on what's going on in the market. And to me, that's not the way like that doesn't make sense to me. Every 2 months, it's going to have a different value up or down. But like it doesn't feel right. So, these algorithms, like I just think we're in a trend right now with lenders where they're just seeing that their numbers showing the property should probably go for this. And every time it's coming in significantly under. Like there was a time in 2022, appraisals were needed everywhere because everyone was drastically overpaying for or potentially overpaying for a property because they needed to. There were 30 bids. So that time appraisals were everywhere. Why is that not the case now? It's yeah, it's the appraising industry is very interesting. I would not challenge you. I would encourage you have an appraiser on and see what they're saying about what's going on right now. If they're hurting, if these like automated appraisal from lenders are really killing their business, or what do they think of it?
I'm almost curious to have, because it seems like with these larger banks especially, that there's so many times where they don't the people who are in charge of the bank don't necessarily know how these algorithms are created or who created them and what factors play into them, right? It's not like you can take a CEO of a bank and they're going to understand what those algorithms are, and those are essentially what's valuing the entire bank's portfolio, which affects its stock price to its shareholders. I mean, like, this is like macroeconomic, market mover kind of, situations here. So this is not a small deal, but we don't really know, right? Like, we don't really have any insight as to how they create those algorithms, and none of it's open sourced, so we don't
That's
really
why.
understand it.
That's why I remember having this conversation with you. You were selling a place at Bathurst Steels ish, maybe it was a condo, and you look on House Sigma. House Sigma says this property is worth this number, estimated value of the property, this number. You're like, no, it's not. And it ended up selling for a boatload more than what House Sigma had it valued at. So that's like, that's my concern as well. Like who are these, what is the valuation software that's promoting X price for specific properties? Like how are they determining this? And are lenders using the same one? I'm not sure. Like with certain lenders that we have access to, it really does have a big impact. If a house is appraised at $1 million and that's what the clients purchase it for, some lenders allow us to kind of stretch out, like register it as a collateral charge for up to 125% of the property's value. So they're just kind of assuming that the property value will grow. So you can kind of register the mortgage at 1.25 million. And then as clients pay down their mortgage, it'll open up access to a line of credit on the 1.25. I know, I know.
That's
Um,
that's
so
that's sketchy, right? Like there's a million ways to see how that could go wrong. And even though that's why I'm like I always find it funny that, that I get so many people in the comments of my YouTube section kind of just saying no matter what that like, "Oh, you just wait, brother, that crash is coming. None of this makes any sense." I actually empathize with them because I kind of agree, right? Like that it doesn't make sense that there's 6 ways from Sunday where, situations where this can go wrong. Um and I agree with that, but somehow it just doesn't, right?
yeah, like I would argue I would argue that the crash, I think we've kind of passed the crash. The crash was when there was nothing listed and nobody was buying, which was kind of summer, fall of 2023.
But that's not a price crash, that's a sales volume crash.
Correct. That yeah, prices were not like maybe in certain areas, absolutely. I had a client purchase in Edmonton. In Edmonton, yes, there's a crash. There was a crash. It's kind of coming back up now. But in the GTA, are we seeing prices absolutely plummet? No, we're not. There are like these random, on TikTok or Instagram, there are random people that said, "Oh, this house was purchased at 1.4 and just resold for 1.1." Sure, there you can always find a needle in a haystack. You could find these one-off properties, but again, there could be a ton of like many different reasons as to why that happened. Or the other thing is, places like House Sigma, if a property sells, it lists as sold right away. It doesn't mean that the property closed. It just means that there was an agreed upon transaction and it's sold. But if it doesn't close, it doesn't, House Sigma doesn't like report that. So it could just be somebody relisting a couple of years later at a lower price.
Well, that's the thing also, right? And that's one thing that I've always found was kind of silly in our marketplace that's different in the United States. In the United States, they do not post the
Yeah,
price of something until it has closed because until then it's just an agreed upon price. You don't know if
which
it's going to
makes sense
close.
to me. Like that process, it should 100% be that way here. Like there are many times when clients cannot close because of 1,001 reasons. But everywhere is reported as sold, and it's reported in the numbers that realtors report on. That like, hey, we had 600 transactions, but how many like actually closed though? We don't know.
Most of them end up closing, but at the end of the day, I think it's not the issue of like how many of them are closing. We know most of them are closing. The vast majority are.
Yeah,
I think the issue is, and this is just a hypothesis, but I think that it's been a massive factor and contributor in our prices moving up very quickly. Because let's say you're in the United States and you have a 60 to 90-day closing. Your latest comparable sale that you're looking at to compare current value on a home that you're negotiating today was something that was negotiated 60 or 90 days ago. So the data being delayed until closing actually means that the latest sale that you would compare to bid over in a hotter market, which is exactly what happens, would have would happen slower, right? It's always going to be delayed by that closing
100%.
time. Whereas with us, it's like last week, right? And so
Last
there's
week,
no delay.
the neighbor sold for 1.2 last week. If it closes, who knows? But anyways, So that now today we got a bid 1.25, whereas like what you're saying is, sure, a house sold 3 months ago at one point at a million or 1.2. What do we think at that? It just it slows it down for sure. I can definitely see that slowing it down.
Right. So we have this constant one upping in a hot market that happens at a much faster rate because we're reporting sales before they're closing. So a lot of things outlined here where I think that, we have things in our system that don't really make sense. And at the end of the day, it's all contributing to a market where obviously we have a ton of pent up demand from taking in way too many people in too short a period of time. And it just seems like every single time that this happens, and we end up with you know a a bubble of a real estate market, everyone gets worried, and then there's a slight correction, there's a crash in sales volume, not in prices, and then it just takes a couple years and then it starts all over again because nothing systematically changes. And so I'm glad we got to hash this out. I do got to cut it here so that I'm making it a bit easier on myself on the back end editing. But I do thank you for spending the time and talking through this with me, and um and we should do this again when we get the next Bank of Canada interest rate announcement, because the messaging I think is so important when they do tell us something, and I want to kind of get your take on it. So when is that next meeting?
March 6th, let's lock it in. 3 weeks. 3 weeks today.
Cool. I look forward to it very much, and I thank you always so much for your time, Jeff Mudrick. Thanks so much.
Thanks for having me, buddy.